Hey guys, Max Convexity here. Beautiful day in Austin, about 70 degrees. I got Jackson back there. Hey Jackson, what's up? Right on cue. Right on cue. I wish he would do that more often. I wish I had him train like that, but that was a total coincidence. He has a mind of his own. Hey, I got a good video today. We're going to do kind of a Sunday wrap-up. We're going to talk about, well, first of all, I want to recap the lesson on Max's math and the high yield math. I want to emphasize some stuff about that. I also want to look at the end of the week buffer report, and we're going to look at the 30-day buffer report also, and we'll also look at the daily buffer from Friday. And then I also want to give my opinion on the top 5 funds of the week. So stick around and we'll get right in the middle of it. Alright guys, it's a big week of my channel. The entire time since I started doing this YouTube channel, since I found out about these high yield funds that pay 50%, I've been trying to think of a way to square the high yield that they pay, the 50% yield or dividend, whatever you want to call it, trying to square that with the NAV price and the total investment. Because, you know, money doesn't just fall out of the sky. You know, birds don't poop money out of the air. There's money doesn't grow on trees. You know, you can't shit money out of your ass, so to speak. It has to come from somewhere. So, you know, a lot of people, me included, a couple of times, were trying to equate NAV and total return. Or maybe when I first started, I was hoping that these guys found an infinite money glitch, or I don't know what else. I knew they didn't. I knew they didn't in the back of my mind, but I couldn't find a mathematical equation to describe what was happening. So this week, though, I think I'm finally at peace. I'm finally at peace with it. My equation is total return equals the dividend yield plus the NAV yield. And I know the NAV doesn't really yield, but just I guess it could be the NAV change. You have to factor that in to get the total return, and that's what counts. That's the truth serum for these ETF funds, is total return, not NAV return. So one of my favorite ways to look at this, just on a real simple basis, is to solve for zero NAV depletion. So if you, and the rule of thumb is you multiply the dividend times 2, and that's what you need the underlying or the parent asset to do to have no NAV erosion, right? And that's assuming a 50% buffer. And the buffer has to do with, because these funds sell options, they cap part of the upside, and they rearrange the risk and reward in a good way, but also, you know, in the grand scheme of things, they cost themselves about 50% of the total return. Generally, you know, if say the Nasdaq's up 30% on the year, you might expect a high yield fund to be up 15% on the year, even including the covered call income, including all that. They're going to be up about half. Some of the funds will be up 3/4, maybe the ones that are a little better, but half's just a good rule of thumb. So if you think about that, if you have a fund that pays 50%, you need the parent asset to be up 100% that next year for you to for sure have no NAV, NAV depletion, for the NAV to be steady. If that's what you're interested in, if you want to buy a fund at 20, you want to have it for a year, and you still want the NAV to be at 20, if that fund pays 50% dividend, whatever parent asset they're tracking needs to be up 100%. So if this is a fund on a single stock, you know, yeah, that's doable. There are single stocks that go up 100% and more in 1 year. But if that's on an index, you're probably going to have some type of NAV depletion. It's not realistic to think that the index is going to be up 100%. I mean, it can happen, but it's not very realistic. A good year in the indexes is what the NASDAQ had this year. This year's a great year, maybe the best year, one of the best years of my life. The NASDAQ was up 55%. That's incredible. So that means your average high yield covered call fund that's selling calls to make an income, and we all know what cover calls do. They cap part of the upside, and they make it where you lose a little bit less on the downside, but you still lose a lot when it goes down, even though it's a little bit less, and then you make a little bit less on the upside, so it causes these funds to recover really slow. A lot of people say they get none of the upside, which of course isn't true, but they don't get a whole lot of it. They get about half to 3/4 of it. So solving for zero is just a good realistic way to look at it. You can ask yourself, if you're worried about NAV depletion and you have a fund that's paying 75%, like Coney is or whatever, just ask yourself, say, hey, is Coinbase going to be up 150% this year? Because that's what's going to happen for me to suffer no change in my NAV, if that's important to you. It's not really that important to me. I get why people, I can see it both ways. I get why it's important to some people, but to me, the total return number is paramount. And I'll show an example of that in a second. So here's another thing. Here's another way to look at my rule of thumb, where you have to double the dividend yield to try to figure out if you're going to have no depletion in the price of your NAV. Here's another way to look at it. How many times in the past 3 months have you heard somebody say to you, if these things are just around for 2 years, it's paying 50%. If it's just around for 2 years, I got my money paid back. Well, no, not exactly. And you can solve for zero. You can use the same type of equation on a 2-year basis. So on a 2-year basis, if you have a fund that pays 50%, it needs to be up 100% each year. So 200% over 2 years for that to happen. So the next time somebody says that, you don't want to burst their bubble or whatever, but yes, it is true. If your fund pays 50%, you'll have your money back in 2 years, assuming the parent asset is up 100% each of those 2 years, or 200% over the course of the 2 years. Yes, then that is a true statement. But that's not going to be a true statement if you have, if say the parent asset's only up 50% a year. Think about that. Only up 50% a year. Those are good years, but you're still going to suffer some, NAV depletion. So it's just the way the math works out. So let me show you an example. Okay, so if somebody said to you, or a lot of people think this, a lot of people think that JEPI, JEPI, doesn't decay or erode, but JEPY does decay and erode. And they'll say, well, look, the price goes down every month. And it did start at 20, and it's at 17.90 the other day, JEPY. So that they'll point to that as evidence of, decay, erosion, depletion, whatever. And we know that decay and erosion are separate things. That's something that does happen to funds that use options for leverage. That's not the problem with these funds, but it doesn't mean that they're, that they don't have problems with their NAV. If you want to call it something else, I call it buffer or underperformance or tracking error, whatever you want to call it. Yes, that is a true thing. Even if it's not, decay and erosion, that is a true thing. So some people maybe don't want a fund with tracking error, or they don't want a fund where they have to worry about the NAV going down. Okay, so, but in this case right here, JEPY versus JEPI, even though JEPY does have more buffer, more decay, it's not decay, but more buffer, or it has worse performance in relation to the underlying, sure. But still, when it comes down to making money, when it comes down to compound annual growth, what you're looking for, it's outperforming JEPI. Even though you can look at it this way, JEPI started a year ago at 55, and now they're at 56. Well, that's awesome, right? Yeah, that is awesome. They've had no depletion in the price of their NAV. Congratulations. But even though this other fund has had about 20% depletion, well, it's about 10%. It's actually 10.2, or no, 10.05. But anyway, it's had a little bit more than 10% depletion, in its share price, it's still a better investment, because once you include the dividends, or I shouldn't say a better investment, not investment advice, not, this is for fun and entertainment only, of course, but it has been a better investment. And this is a small sample size that we're only going back to September 19th. The other thing I want, that I've showed this a million times, and I'll keep showing this a million times, the JEPY uses daily options. Daily options give you more buffer on the downside, and you can see it in this chart. If you look back to October was a pretty good test for what happens when the market moves down to these high yield funds, because it did. It moved down sharply in October. And look at JEPI, the one that supposedly has, less NAV depletion, less bad stuff going on with the SNAV, JEPI, whatever you want to look at it that way. Yeah, it's a good fund, but it didn't do as well in the bear market. In fact, JEPY did quite a bit better, and it's because they're selling daily options. It's not in spite of the daily options, it's because of them. The daily options give you more downside buffer. They just give you more, they give you more upside buffer too. They give you more buffer. If buffer's what you like, the daily options do it. And they also spit off more yield. Well, the yield is the buffer, so I guess that shouldn't surprise us. All right, I'll keep watching this. This is a small sample size. I'm not saying JPI is a bad fund. In fact, it's a great fund. I mean, you don't get $30 billion under management for nothing. It's a great fund. It has a good expense ratio. It's a good company, but you can just look at this to see, this is just a prime example of total return does not equal NAV return. In fact, NAV return's only half of the equation. It's just important to keep this in mind. I know a lot of you guys know this. I'm sorry I go on and on about this. All right, so now that we're talking about buffer and underperformance and outperformance and all that kind of stuff, let's go look at my buffer report. And I have a new methodology, or not a new methodology. I discovered that I had an error in the 30-day on the 30-day chart. So a few of you guys have caught it. I've got comments before that told me, no, it's not down that much. Yeah, I had an error. I fixed it, and I appreciate everyone's patience. I appreciate everyone for the ones of you that mentioned it for me. I appreciate that. In addition to fixing the error in my formula, I also switched the format of the buffer report a little bit, where we're going to start looking at the buffer on a graph instead of graphically. It just makes it easier for me. So on the left in blue is the high yield fund, and on the right in red is the parent asset. So this is just over 1 day. Now, okay, the market, the S&P was just up 3/100ths of a point on Friday. This is the perfect condition for covered call funds. Is a market that's flat, or up a little or down a little bit. Covered call funds really thrive in that kind of environment. So it shouldn't surprise us to see all of these funds beat the parent asset. I don't know what's going on here. But I know SPY beat the parent asset. I don't know why that's not showing up. But anyway, JEPI, had a good day. I mean, it was up 21 basis points. JEPY was up 28 basis points. That's because it has more buffer. The dailies give you more buffer than the monthlies. Now, the other side to that is, though, in a bull market, you don't want as much buffer. So in a runaway bull market, these funds like JEPI and JEPQ would do better. So it's not just like, they're stupid because they don't use daily options. No, not at all. Daily options give you more buffer, but daily options also, with more buffer comes more upside cap. The buffer is what causes the upside cap. All right, so iSPY outperformed. Like I say, I don't know on SPY. We aren't going to worry about that for now. GPIX had a good week. These all did. And look at Bally. Bally got a 44 basis point, NAV appreciation just on Friday alone. Okay, well let's look at the Nasdaq. Now Nasdaq did a little worse. The Nasdaq was down 37 hundredths of a percent, or a 37 basis points. Nasdaq was down. Well, QQQY definitely outperformed. They'll always outperform. They should outperform when it's down, because once again, because of the buffer. In fact, I would expect QQQY to perform the best because it's the only one on here that has daily options. Actually, I take that back. QQQY does as well. But in any event, it didn't this week. Bally was the big winner of the week. You know, Bally killed it. And I don't know why Bally's on both charts. Bally's underline is SPX, not NASDAQ. So I need to fix that. Anyway, now let's look at the, let's look at the single day on stocks also. This is so much better than looking at those damn numbers. For me it is anyway. Okay, TSLY outperformed. Look at that. That's awesome. Parent was down 2.7. TSLY was down 1.8. Heck yeah, we'll take it. Look at NVIDIA outperformed. NVIDIA was up 1%, and parent asset was up less. Coney outperformed. Pretty much all these outperformed. AMZ outperformed. Aptly outperformed. AMD outperformed, although not by as much. TSLP outperformed in about the same way that TSLY did. TSLP was down 1.9. TSLY was down 1.85. Very similar performance. The only reason there's a difference on those, when there is, and there is a lot, is because TSLP uses monthly options. TSLY concentrates; they sell weekly options. All right, MRNY outperformed by quite a little, good little manner, a good little ways there. I don't know what I'm trying to say. MSFO was in line. PP outperformed on the upside. That's good. FBY outperformed. DISO outperformed. InFly outperformed, but not by much. But Sky, look at Sky. Boy, you know, they always say these get none of the upside. Well, don't tell that to Sky. It's just one day, but heck, it got 11% in one day. Where of course Square had Block, or whatever they call it now, had earnings that came out Thursday night after the market closed. The market liked them. The rest of these were in line. I don't know what's going on with MSFY. I need to look at that. On a single day, sometimes because of the spread between the bid and the ask, and just because of different stuff, these aren't too informative to look at. I just try to look for patterns. What I think is more inform my opinion more is looking at the 30-day. Here. So let's go to the 30-day on the single stocks, since we were just on the single stocks. All right. So now this is great news for these funds. Look at TSLY, killing it. I mean, outperforming over 30 days. This is where I had the math error, was on this chart. Like I said, a couple of you guys brought it to my attention, and I just had to get in and figure it out. I appreciate that, though. NVDY, has great performance. Don't tell these guys they get none of the upside. They were up 18% in the past 30 days, where the parent was up 20%, 21%. I mean, that's awesome. Coney's more in line with what you would expect. I say the typical buffer's about half. Coney's up 11, parent was up 20. Look at OARC. OARC killed it over 30 days. OARC's up when ARC is down. I mean, that's great. AMZ outperformed over 30 days. Aptly underperformed, but about to the extent you would expect. But AMD had a 30-day outperformance. TSLP had a 30-day outperformance. See, once again, TSLP doesn't have as much outperformance as TSLY. Well, that's because TSLY is captures more buffer by selling the options weekly instead of monthly. However, that means in a big up move, TSLP will probably do better. In a down move or a sideways move, we would expect TSLY to do better. If you knew Tesla was going straight up, obviously you don't. You just buy Tesla if you knew that, I guess. Buy Tesla calls. But if it's in a bull market, the monthly ones will perform better. The ones that just sell monthly. In the sideways and bear market, the the dailies and weeklies will perform better. Okay, MRNY underperformed, MRNY outperformed. And that's where these really come in handy. Look, the parent asset was down, 9%. MRNY was down about half that. We'll take that. MSFO over 30 days outperformed. PP outperformed over 30 days. That's a pretty good outperformance. PayPal was down 7, and PP was only down 2.5. Look at Meta, or Facebook, FBY, whatever you want to call it. It looks good. The ISO looks decent. Infly's a little disappointing. It underperformed. That's a little disappointing. Of course, Square, Sky, whatever you want to call it, is killing it over 30 days. Parent's up 12%. Sky's up 11.8. Wow, that's nice. Now, GUI underperformed a little bit, and on the downside. That's certainly not what you want to see. That's not the way it's designed to work. Now, Goop is more how it is designed to work. I don't know what's going on with those two funds. I mean, GUI does sell weeklies, and Goop sells monthlies, so I would expect that to be opposite. I would expect GUI to have more downside buffer than Goop, but it didn't work out in practice over the past 30 days. I don't know if GUI made some bad trades, or who knows. Maybe I have a bad number in there. I could check. MSFY, it outperformed. Okay, this one's, I shouldn't have put that one in there. Obviously, MSTY hasn't been out 30 days yet, so that's not a fair comparison. But then you can look at the average. So the average one was up, the average high yield fund was up 3.1%. The average parent was up 2.76. So on an average basis, they outperformed. Now, it is including this MSTY in that average. But still, even if you take MSTY out, we still have an average outperformance in these single stocks vis-a-vis their parent assets. That, to me, is impressive. Let's look here at 30-day SPX. These are the S&P, high yield funds. Okay, so the S&P had a pretty good 30 days. It was up, 3.16%. Well, JEPI got about 2/3 of it. That's very respectable. JEPY got about 1/5 of it for some reason. JEPY did not have as good a performance as JEPI over those 30 days. Now, we just saw a chart since inception. JEPY is beating JEPI, but not over the last 30 days it isn't. So, here we have iSpy. iSpy is a really good fund. Gets a lot of upside. SPY is a good fund. It gets a lot of upside too. And look at this. The Goldman Fund, GPIX, got almost full upside. I'd say that's 85% or so of the parent asset. XYLD, got about 1/3 of the parent assets upside. BALI, Bali, outperformed on the upside. That is impressive. I like to see that. Over 30 days, too. So now let's look at the 30-day NASDAQ. All right. So QQQY just is the worst performing on here, unfortunately. JEPQ was outperforming the benchmark over 30 days. So's Bally. We saw Bally on the other chart. Bally, doesn't matter what benchmark you use for Bally, S&P or NASDAQ, it's outperforming all of them. All right, QQQY outperforming. And this is a new fund, but it's not that new. It's been around for 30 days. QYLD underperforming. About in the manner we'd expect. GPIQ, the other Goldman fund, outperforming. So to me, these high yield funds, other than a few outliers, when you look at the 30-day performance, and you look at these, the S&P, and you look at the 30-day single stock, I mean, they're doing pretty darn good in my book. Let me know what you guys think in the comments, but it's been a pretty decent 30 days for these guys. All right, now let's look at Max's funds of the week, and I'm going to Bally, number one. I like Bally. I did a review on it. Go check out my review if you haven't. But they have good methodology. They use futures for a little extra leverage, which is maybe why they're outperforming on the upside. But it's beating everything right now. It's killing it. All right. So then I'm going to also say JEPY. I mean, it's no secret that I like the daily option that Defiance does, that daily strategy, because I always talk about it has more buffer, and more buffer is important, in down markets especially. But I really thought it was impressive that JEPI, even with worse performance in NAV, even including the worse performance in NAV than JEPI, it still has better overall performance. I think JEPY is pretty solid. Then I'm also going to give numbers 3 and 4 going to be Sky and NVIDIA, just because as far as single stocks go, they just had a really good week. And something else I realized when I made my theorem was I was discounting how important picking the right asset is. Because when you need that kind of performance so you don't have a problem with your NAV, if that's what's important to you, it's really important that you pick a parent asset that does well, and not just average, like way above average. So that's where Sky and NVIDIA come in. These things are hot. And I'm not saying go buy them or whatever. It'd be recency bias to buy them. Who knows if they're going to be hot over the next 6 months? But over the last 6 months, they've been on fire. So I'm just reporting. I'm not predicting. I'm just reporting what has happened. So anyway. And then also, I want to talk about TRES, because that's a big mystery fund, but it's been bleeding money for a couple of weeks, but it put on a new position on Friday, and they made money on Friday also. The way I've been tracking it so far, and it's because they don't give us intraday trades like they do in the other Defiance funds, and I don't understand why, but I don't get the exact fill prices. But the day they put on the options, I can figure out what the fill prices are just by dividing how many units they have by how much money they receive. So I figured it out. But then what happens is, let's say it goes along for a week, and then more people buy shares, and they want to add some contracts. I don't know what the add price was, but what I'm following is the general strategy based on the roll and stuff. This will be close to how. This is their strategy, and how this is doing. It will be close to how the whole thing's doing, even including the when more money comes in. Okay, so if you look at what these guys did, anything on option strat, anything under the line is a sold option. So they have 2 puts sold, and anything over the line are bought options. So they have two call options, or they have a call option bought and a put option bought. And then they have a put option sold and a call option sold. So let's look at the individual ones. The put option was at 92.5 when they did this trade, which was close to where the market was. I think the market was at 93 for TLT, but it was close. Anyway, these guys sold this for $1.05. It's already down to 51 cents. So that's good. They're making money. On the call, they sold it for $1.08, but it unfortunately is losing a little bit of money because it's worth around $1.80 right now. But the put that they sold for $1.05 is down to 50 cents, so that's making money. Now the calls they bought up here, they bought these calls for $1.10. These are the 93.5, the out of the money calls. And they're up to $1.66, so that's pretty good. They're making money on that part of that, leg of the trade. But then over here, they also bought some puts, and these they bought for 99 cents, and they're down to being worth 56 cents right now. But when you add all that together, they're up a couple thousand. They're up a couple $1,000, and as of at the close on Friday, they were up about 5,000. We've had some time decay hit over the weekend, and now they're only up about 1,000. So what happens as time passes, this valley of death is this red area. and they don't want the price of TLT to end up in that red area. It's a loss. What happens as time goes by, I'm going to make time go by, you can see the valley of death expands. So if time goes by and the price doesn't move from where it's at, we'll be in a losing situation. We want the price to either go up a lot or go down a lot when you have this kind of trade on. So I can move it all the way to the end. That's what the profit loss graph will look like at expiration. So at expiration, but now expiration is a week away or 2 weeks away. Actually 4 weeks away. It's 2 weeks away for the options they sold, and then 4 weeks away for the options they bought. Yeah, because yeah, that's exactly right. It's 2 weeks and 4 weeks. So we shall see. One thing I would say about this one, I don't know if my video is going to be on first, but Panda has a video coming out at 4, and he's going to do a week wrap-up on Defiance. And he is a master's at finance, but he also worked on Wall Street. He has done a better job covering TRES than I have. This strategy they're doing is kind of not a retail strategy, even though I've done it a few times. It's definitely a commercial bank type strategy, and he has really good coverage on it. So I'm going to be watching him, and I'm sure you guys will too. So after I see what he says about it, I may change my mind. But generally, here's my one takeaway on it, and here's the one way that I missed it. I think I was too hard on this fund. I made an error. I was saying I wasn't sure how they were going to do this because they own this spread they have on, this ratio diagonal spread they have on. They own twice as many options as they have sold. The sold options are what bring in extrinsic premium and are what give you an edge. That's always the way I've understood it. So I was thinking because they have more long options than they have sold options, they're going to bleed money. Well, no, when I started looking into it and I did a back test on it, and I would show you right now, but the Tasty back testers engine is down right now. But no, they do have an edge. Even though you have twice as many long options as sold options, they darn sure have an edge. And so this fund is really going to be interesting, and it's going to make money in a different way than the other funds do. So I think it's going to be a good hedge. But like I say, watch Panda for some more, insight type information. I can't wait to see what he says about it. Thank you so much for watching, and remember to check anything you hear me say or anything you hear anyone say on the internet or anywhere else for that matter with your own professional, your own financial professional. Retirement, money, this stuff is serious, and like I always say, the internet's great for research, but maybe not such a great place for execution. So, check this with somebody that knows you in real life, that knows your own situation, your own risk tolerances. Like, look at me on that 30-day chart I had that I was, tracking the performance of stocks, of ETFs. I had a mistake on it. Well, anyway, the mistake wasn't on purpose. It wasn't malicious. I don't think anyone acted, bought something because of something they saw on my chart. But if they did, that would be bad, because then I come back and I say, well, actually, and my mistake was I was actually not giving the high yield ETFs enough credit. Maybe somebody saw my chart and sold, or did something. Anyway, that's just an example. Like I say, I'm not a bad guy. I'm not trying to do it intentionally. I'm not trying to do it for clicks. I'm trying to do the best job I can, but I'm just one guy and I make mistakes sometimes. So that's just a great example of why you don't want to take advice from the internet. You guys have a great day.